Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
Just business news, we're news for business people. Hello and welcome to Bloomberg Quint Live, India's first live streaming business news service. I'm Menaka Doshi.
This is Bloomberg Quint Mornings. You're watching Indian Open. I'm Neeraj Shah. Good morning, Menka. Good morning, Ira.
Good morning, and good morning to all of our viewers. Let's get straight to the headlines. Asian markets open in the green for the first time after 5 trading sessions. In the US, our conversation continues around the flattening of the yield curve, its implications for US Fed decisions from here on as well. IIFL subsidiary 5paisa Capital will become India's first listed online trading firm when it debuts on the bourses today. Narendra Modi remained popular even after the cash ban, shows a survey conducted by Pew Research.
Well, and the markets might have an inkling of green at the start of the trading day today. The question mark remains whether the weak trade setup that we are in or the weak trade pattern that we've seen for the last few days will come in and envelope the markets today. Remember, it's the Bank Nifty weekly expiry as well, so that will dominate the banking pack, which was rather outperforming in the session yesterday. But just a quick setup, really. One, what's happened to the world markets overnight? The US markets have ended with a bit of red, but it was not too bad, and which is why the Asian markets are likely to start off, and rather all of the markets are trading in the green, and the SGX Nifty is indicating that we'll have a mild bit of positive start as well. The ADRs pointing towards private banks at least continue to do well. That was not the case yesterday, but if you look at what's happened to HDFC Bank, for example, that the ADR has ended 1% higher. Let's see if banks might actually be the saving grace for the markets today. Yesterday they held out, which helped our markets in a big way. But commodities are off. Crude is corrected yet again. save for aluminum, most of the metals at the LME and as well have corrected. So you might have a slightly rough day for the commodity pack today as well. Remember yesterday, Vedanta, Hindalco, Tata Steel and a clutch of these commodity names were down and out in the session. The question mark only remains as to what happens to the broader markets, because the market breadth was terrible. I use the word terrible with a purpose. 1:5, and it only worsened in the second half of trade, and we all know the story. We'll discuss a bit in detail about what happened to the Anil Dhirubhai Ambani Group stocks, but that notwithstanding, a bunch of other liquid names, the JP Associate pack, or the JP Group pack, Adani Power fell as well, a clutch of other commodity names which are in the FNO space too corrected quite viciously in trade yesterday. So I think all eyes will be on how the broader end of the spectrum performs. And in terms of stocks to watch, aside of course all of these stocks which corrected quite strongly in the commodity names, I think in terms of newsmakers, not too much. One eye maybe on IIFL, its subsidiary list today, and it's interesting. We've seen what's happened in the past to some of the other names were in the subsidiary list, and there is a bit of a holding company discount coming in. But IIFL is a different kettle of fish. It has corrected a bit, as have all the others, save for Edelweiss. So maybe a bit of valuation has become a bit favorable. But let's wait and watch for IIFL holdings. I'll watch out for Indian hotels as well. I'm meeting a clutch of international investors. The market typically tends to get excited on such news. A couple of result boys that came out post-market hours, really nothing to watch out. And a bunch of names in the FNO band today. You would have expected with the kind of trading that we saw yesterday. So 11 stocks in the FNO band. Let's see if some of those react or no in the session today. But yeah, I mean, the newsmaker list is slightly thin. But I think the news were made in trade yesterday with the kind of trading patterns that we had in a bunch of names.
Okay, we have an interesting listing today, 5 paisa.
Yeah, so that's something that should keep the IIFL one
in the
excited.
world of discount, broking or online broking. It'll be interesting to watch how that stock is received. It is the first discount broking online broking platform to list on the bourses, right? Yeah, I know. It's fun to watch what happens with that one, especially because it has big competitors in Zerodha and the rest. All right, let's tell you what's on First Word this morning. We're going to first head out west. That's to the US. Is the narrowing gap between long-term and short-term bond yields. That's the 2-year and the 10-year in the US. The new challenge that the US Fed has to face. That's the big question that has been dominating bond markets globally all this week. Ira is going to talk a little bit about that later on. 2017 has been a record year for IPOs, with almost all of them being oversubscribed and many of them listing at a premium. But how have IPO investors fared so far? And we also have on First Word this morning, Reliance Communications, that stock dropping lower every day. What does that mean for ADAG stocks? How are they holding up? Neeraj is going to give you some insight on that. But we'll kick it off first with this yield curve conundrum, as they're calling it, the flattening of yield curves. What exciting 8 a.m. morning conversation here.
No, it is, but it's important.
It is important.
These signals always emanate from the bond market, in my defense,
course.
and the currency markets, and then they follow through into equities.
But
this is not a debate about equities versus bonds. This is not something that's happened overnight. This is something that's been happening for the last few days, but more and more people are talking about it because it's a process that seems to be continuing at least for the last 7-8 days. So just pulling up a couple of charts, and these are charts which are showing you the difference between the 2-year bond and the 10-year bond. That's the first one on your screen. That's the 2s to 10s, as it's called. And the gap between the yields on the 2-year bonds and the 2-year and the 10-year bonds has narrowed now to about 67 basis points, if I can read that right. So that's the first curve. This has been consistently, as you can see on that chart, been narrowing, and it's now fairly flat, the flattest it's been in about a decade or so. Overnight, there was also a flattening on the 5s to 30s, as it's being called. So that's a similar chart, but that gives you the gap between the 5-year yield and the 30-year yield, and that too has narrowed considerably. Now, what is happening? A flattening yield curve, as all of us are familiar, perhaps suggests, at least in traditional theory, suggests that you're heading towards a recession, or you're heading towards a period where there could be some economic weakness. An inverted yield curve signals a recession. A flat yield curve signals that perhaps there wouldn't be the kind of economic growth and inflation that accompanies with it that you would anticipate. So the debate being, the story being debated in the global markets is are the lowering yields on the long end suggesting that the market does not believe that the Fed will reach its inflation target? We already know that the Fed has been underperforming, or inflation has been underperforming the Fed's targets, and the long yield seems to be suggesting that the market does not believe that it'll meet those inflation targets. So then the question is, if it doesn't believe over a long period of time that it's not going to meet those inflation targets, then should it be raising rates as aggressively as it is? The short end is suggesting that those rate hikes are going to continue, which is why short end yields are going up. So that is the debate out there. Does the Fed take note of this and the expectation of the bond market and change its interest rate trajectory? That is sort of the question that is being debated out there. Now, there were some comments coming in from Fed officials and, different, tax being taken on those. One official saying that you can't read into this flattening yield curve as you would traditionally. Market conditions are very different right now, and perhaps that is true. Others saying that, yes, it needs to be taken note of. Just, one point, guys. I mean, earlier in the week, we had a conversation with the Nomura India rate strategist. So, my question to him is that what does it mean for us? Does it impact flows into our debt markets? His point was that he would be more worried if the terminal rate, which is where they expect the Fed rate to settle, were rising. He said for us that would be more damaging in terms of fund flows than this flattening of the yield curve. So that was his theoretical thought on that. But if you look at the numbers on the Indian debt market, and that is the chart which is telling you about debt inflows this month in November have been negative. Small negative, but negative for the first time since January. So you have about a net sell of about 1,000 crore or so. Yesterday there was a buy, but for a series of days before that in November, there had been net sells coming in from foreign investors in the debt markets. So there is some nervousness. Theoretically, it's not clear to me that the flattening of the yield curve should impact flows, unless of course it riles the overall global market sentiment. Then of course all bets are off. But theoretically, I'm not sure why the flattening of the yield curve should impact flows into India.
Just a couple of questions on that. So could it not be, just to go back to the point that you made about us seeing some outflows from the debt market, which is fairly unusual given that, we've had foreign investors sort of hitting the limits almost every time. But we're still, I think, at 98, 99%, if I remember correctly, of the limit, right?
So we are very, we're full up on the government bonds for sure. It's just that it's a small negative this month after a long season.
Could it also be, given the confusing data that's emanating from India, and the fact that we are at the year end, this is typically when foreign investors close out books, right? For the year, you want to book your gains, get out of the market, take your Christmas holiday, and then come back in January. And January, February, it will be in a big way the budget play. Also, we're finally seeing some recognition of, look at what has happened to yields in India, right? Yeah. We're finally seeing some recognition of how the GST revenue may not deliver, what we had expected, what that might do to India's fiscal deficit. So could it be more local factors is what I'm asking you?
It could
local and seasonal factors, the fact that we're at the year end, that might be playing into this as opposed to what's going on in the US with regards to the yield curve flattening.
It could very well be. I think domestically there are two different factors. One is, of course, that, bond prices are coming off and yields are going up. So the people who already invested may be tempted to book profits, as you said. On the flip side, as yields go higher, and I was reading a note yesterday, the expectation is that if you go above 7 and stay above 7, that high yield play will bring investors back in.
Okay.
It could play out. It could play out either way. But yeah, there's very, very difficult to correlate it directly with that. It's just the timing is the same. But I was curious to know whether the flattening yield curve will impact flows into emerging market bonds. And Vivek Rajpal of Nomura, who spoke to us on Monday, was not entirely sure that it would. He said that I prefer this as opposed to a rising expectation of terminal rate, as he kept calling it, which essentially suggested that if they were expecting the Fed to raise rates faster and the yield curve was steepening because of that. That he said would be more damaging for us.
Okay, it's interesting. As yet, we've not seen any data in the US to suggest any kind of growth slowdown, though the inflation target being met in any fashion is still the big question that the Fed is raising, right? And I think everywhere central banks are scratching their heads saying, are we reading inflation wrong altogether, or inflation expectations, is that the big question? But we have an interesting story up on the site as well on exactly this issue.
And just one more point. I think the only other thing that happened overnight in terms of, worth taking note of is the sell-off in the high yield segment, but that also everyone said it was the absolute, the low end, so the highest of yielders, which were seeing some sort of sell-off. But it's very early days yet. It could change quite quickly.
Okay, all right. Do go to BloombergQuint.com. We've got a very interesting story there, which takes exactly what you're saying forward on the bond conundrum that the US Fed is facing. That's on BloombergQuint.com. We've got Reliance Communications coming up next. Here?
Yeah, well, so the question mark, or rather not a question mark, it's almost a jury that everybody's spelled out that it's RCom's woes that are actually impacting the entire pack. Probably not untrue as well. But, this will take some time, guys. But here's what I'm trying to do here. One, show the trade pattern that happened yesterday, and it's probably identical to something that we've seen in the past as well. And which of these RCom group companies, there's 7 listed entities out there, which of these are probably, to the best of estimates, shielded from any kind of trouble that may come in. Now, this is the first set of stocks that I'm pointing out. This is the trade pattern yesterday. Reliance Nippon AMC, the recently listed one, Reliance Home Finance, the demerged entity, and look at those two charts, compare them to what happened to the other RCom group companies, so Reliance Capital, Reliance Communication, or any of the others. These two saw some bit of buying. It got my interest peaked a bit, so I looked at the delivery patterns for all the 7 names, and quite frankly, there's a pattern there. Both Reliance Nippon and Reliance Home Finance had fairly high delivery percentages, 53% and 64% respectively. Compare that to what the others did, and there was just virtually no buying in any of these in the cash market. I'm not using the derivatives market too much because, save for Reliance Capital, there was no F&O activity worth noticing, quite frankly. Just shorts piled on to a small extent, but no F&O activity which was brisk, save for Reliance Capital, which added around 6% of short positions overnight in trade yesterday. Now, just the 3 or 4 principal names that you probably want to point out. One, the cloud over the companies is, now, what happens to Reliance Communication? $1 million question. I think we've discussed this in the past a number of times. I remember a headline that we had that could this be one of the first Reliance Group companies to head towards insolvency, so on and so forth.
First Ambani insolvency.
First Ambani insolvency, right? Now, the question marks over SDR as well. Me and Ira were having this conversation in the morning, whether this goes through or it doesn't go through, because they're caught between a rock and a hard place, quite frankly, in whether convert the SDR at a price of, 10 rupees when I think the discovered price was 24.7 if I'm not wrong.
Right.
And I'm sure Ira will have some more thoughts there. And something that I picked yesterday, late night, from a lot of people is that the group's exposure to Reliance Communication is still unclear. There are a couple of numbers that have come out for a couple of group companies, but overall, the market, at least the market, is still grappling with or wondering whether the other group companies also have some heightened exposure to Reliance Communication or no. At least the market doesn't seem to be knowing that. Three people that I spoke to are not completely clear. They are saying some numbers floating in the market, but it's very opaque.
What do you mean by exposure?
So if any of the group companies have lent to Reliance Communication as well, one of the group companies, Reliance Capital, is apparently having some exposure, but the others, you don't know if that is there or no. So the market is grappling with these numbers. They are not unsure, and which is why you're painting the whole group with the same picture. If RCom is going down, hey, even the other group companies might be in a problem. That may not be the case. That's the point that I'm trying to bring out here. That may not necessarily be the case. Now look at Reliance Infra, one company, right? Indebted company, FY17 debt as per their presentation, investor presentation that they made, is at 29,000 odd crore rupees. Now, they have some decent businesses, and if they indeed are able to monetize the Mumbai power business, the talks are that they could get around 13 to 14 odd thousand crore rupees from this business. They are entered into a period of exclusivity with the Adani Group. Let's assume that those are the numbers that turn out to be true. That's not a bad number that comes in, and it's a stated objective is to reduce debt. So that brings that consolidated debt picture down by 50% and 12,000 odd crores of debt, which seems a lot more manageable than the 30 odd thousand crore Herculean number that they're sitting on right now. So that is one. So it's not all bad for Reliance Infra. Now, Reliance Nippon Asset Management, you would presume that a company which got subscribed 81 times when the issue just came out, people who've put in those bids have done the due diligence. Remember, retail doesn't take the subscription up to 81 times. It's institutional which does this. So Reliance Nippon might well be shielded by this. It dropped below the issue price yesterday, guys. After listing at about 285 or thereabouts, if I'm getting my numbers correct, it dropped below the 252 mark, then saw some bit of buying emerge in late trade. This is the post-closing price, 253, otherwise almost ended at about 260. So there's some bit of buying that came in out here. And most people say that this is probably that one group company that will not have any kind of repercussions because of Reliance Communication.
In fact, all three financial...
yeah, you would presume that. I mean, just the
three stocks that represent the financial business.
Capital, Home Finance, and Reliance Nippon Asset
seem
Management.
to be in fine fettle, though they don't seem to be as disturbed as maybe some of the other businesses. Even the defense business seems to be all right, right?
Yeah, I mean,
I think defense, they were doing some further capital infusion from the promoter end recently.
What I mean to say is that the prospects don't look so bad for the defense business.
yeah, you just don't know what the prospects are, quite frankly, for any defense name right now
fair
because
enough.
of capacity
Okay,
utilization. But, and Reliance Capital, as I said, now this is what the market is working with. You know, the actual numbers may well differ and the market a lot of times gets it terribly wrong, but a lot of times people in the market get it bang on, which story later emerges. But Reliance Capital, people are a bit sketchy. One, the holding company discount, of course, now starts coming in. So ever since that big star in that group, which is Reliance Nippon Asset Management, got listed, people said, okay, now I don't need to own Reliance Capital. I rather own Reliance Nippon Asset Management. So from 590, the stock has come down all the way to whatever, 420, 425, 430 odd rupees. So this is the holding company discount that is coming in. But you got to remember that it's a parent of multiple financial services business, all of which seem to be doing well or are stated to do well. I mean, they're in the right space at least. I mean, life insurance, general insurance, it's a pocket that will only grow. Now, whether Reliance manages to grow it or not is a separate thing altogether. And we all know that Reliance Nippon Asset Management is doing well. They have a 42% stake out there. So you'd probably attribute this to group nervousness and some bit of holding company discount that is coming for that. But it would, to my mind, it would be wrong to paint 2 or 3 of these names with the same brush. Even Reliance Infra, which has got debt, but it's got assets which it is trying to monetize, has monetized in the recent past, trying to monetize more, getting some arbitration awards in, might get some money in which will be used to pay debt and get debt down to a manageable level. So yesterday was, well, you know, all group companies being painted with the same brush. I might be wrong to do that.
Look, but the cloud over Reliance Communications is undeniable.
Completely.
Yeah, no, it is. I mean, we don't know how this is going to play out. You know, you already said the SDR problem. I need to check this, but yeah, so hypothetically, if they were to become an NPA, yeah, so I don't know if it would have any bearing on the government contracts that other group companies bid for. I know that if you are an NPA, you can't bid for government contracts. I don't know that there would be any sort of, you know, interplay between another group company. So
If
I'm
it's
talking
promoted by the same set of promoters.
Yeah, I don't know that for sure.
Look, this is unprecedented
Yeah.
at several levels. I mean, one is the headline-grabbing sentence that, oh, it's an Ambani company insolvency. If that were to happen, and we know one company, one lender, or let
This
me
is
call it
Manipal
one
Technologies,
creditor,
creditor,
which has, I think, a 2.5 crore rupee,
Very
sort of outstanding,
small.
But they're the ones who I think are attempting to take this to insolvency. The lenders are hoping that, you know, the SDR process will work out, which at this point in time is looking really difficult for it to work out. If the discount price is $25 and the market price is 10 rupees, they're contractually committed to turn it, not contractually, that's the wrong word, but the principally committed to turn, to convert their debt at $25. But if they do it at this point in time,
they'll take a mark-to-market hit, as Neeraj said. And I'm sorry, I'm just going to say one line from the lender's perspective, and I'm repeating myself here. But I mean, this just goes to show that even the strongest of, bankers are not completely sort of, insulated from quarterly earnings pressure. I cannot understand why they would have agreed to this SDR. I've said this every time we've had this discussion, so I know broken record, but I still can't get it.
I'm not going to attempt to defend them because I quite agree with what you're saying. But maybe when they did decide this, which was in June this year, if I remember correctly, and we've been discussing this in the newsroom a lot over the last few days, right? When they did decide, maybe they felt reasonably confident of both that Shyam Sistema and SL deal going through. And they thought that, this is a convenient SDR, right? I mean, we don't have to do much to hawk this asset. The asset's going to find its own deal, which is halfway through the process, which is why it was a convenient SDR to do. Except that now they're stuck because the deals, that one deal happened, the other one, the big one is not going to happen. And now they're stuck at having to convert at $25. Whereas the price is $10. So optically, it's going to look so bad.
Yeah.
But what can they do? I don't think that there is. I mean, under SDR regulations, you have to convert at whatever the price.
You can choose not to convert, but then you have to mark it down into an
Mark it
NPA.
down, yeah.
You can choose not to convert, but then you have them marked down into
This is like a bucket of oil. So frying pan, fire, I don't know. It's just like you're in a bucket of oil, right? Yeah. On both sides. So, yeah, it'd be interesting to see how this, and what happens if Reliance Communications is admitted to the insolvency process. Sorry, this is very speculative. So I apologize to all those viewers there who are invested in the stock. But if they are admitted into insolvency, then what happens to the lender's STR process?
Yeah, I don't know. I don't know the answer to that question.
No, it's all unprecedented. That's what I'm saying.
Exactly.
So we're going to discover all this as things go.
Yeah.
Because I don't see us having experienced this before at all. I mean, it's been only 1 year of the IBC. This has never come up before, I think. So it's a bit curious. Okay. That is the story on the ADAG Group stocks, more specifically Reliance Communications. Now, let's move on to what's been a pet theme in 2017. It's the year that's seen the highest number of IPOs since 2011. 32 companies raising nearly 50,000 crore rupees from the primary markets. And some of them, such as Avenue Supermarts, listed at a fantastic premium of more than 100% to its issue price. But not all have suffered or enjoyed the same fate. So what does all of this mean for those of you who invested in IPOs? It was a great year for IPOs, but was it a great year for IPO investors? Sameet's been crunching some data on that to give us some fairly revealing numbers.
So far in 2017, 32 companies have been listed, and most of them have given investors gains on listing day. But what we are going to see here today is how the share prices of these listed companies moved from the closing price on the listing day till now. So out of the 32 companies that have listed, 20 companies have given negative returns from their respective closing prices on the listing day till November 15. Now, 9 companies have given return in the range of 10 to 132%, while 3 companies have given return in the range of just 0 to 4%. So let's first see the top 5 companies that have declined the most. S. Chan, that is a book publisher, listed at a gain of around 6%, but post that it has declined around 31%. CL Educate, the coaching class company, listed at a discount of 21%, and post that it has declined another 24%. GTPL Hathway and Bharat Road Network saw flat listing on the exchanges, but post that they declined around 16% and 14%. Godrej Agrovet, which is the agribusiness company and the subsidiary of Godrej Industries, listed at a premium of 35% to its issue price, but post that the company has declined around 11% on the exchanges. So now let's see who are the wealth gainers and who have gained the most. Shankara Building, which is the retailer of home improvement and building products, listed at a gain of around 19% to its issue price, and post that the company has gained more 132%. Apex Frozen Food, which is the shrimp exporter, listed at a premium of 14%, and post that it has gained another 131%. Then Avenue Supermarts, who saw a grand listing of more than 100% on the exchanges, but post that it has gained only 72%. Now here PSP Projects, listed at a discount of 5%, but post that it has gained more than 90%, while Tejas Networks, which saw a flat listing on the exchanges, managed to gain close to 50% post that. So it's not necessarily always the companies that gain on premium to their issue price gain most after that. So companies which have gained not much on the listing day have managed to give returns post that. That's what we see from this picture.
So the returns are from the issue price or from the listing price?
These returns are from the closing price on the listing day till November 15.
And you've done that only to mark out the volatility of the open first.
Yeah, exactly.
Just to eliminate that volatility,
exactly.
you've
Because
taken the...
You see, for Avenue Supermarts, it has given the highest return because it listed at a premium of 100%, but post that it has just given a return of 72%. While companies like Shankara Building and Apex, which saw muted listing, but post that they have given more gains to investors.
Yeah, well, I thought what stood out for me was that 20 out of 32 actually have negative returns
post-listing.
Since listing.
Post-listing, yeah. I mean, if you just bring that number down to the issue price, then I think 14 companies trade in the red compared to the issue price, and compared to the price as of yesterday, it's about 14 companies that
14
are
of 32 are negative even from the issue price.
Negative from the issue price as well.
Yeah, that's 50%.
And most of them are, I guess, insurance companies. Recently listed.
The last 5, right?
Yeah,
last 4 or 5.
But I thought ICICI Pru was up.
No, ICICI.
Not ICICI Pru.
Recently listed.
Recently.
The 2 government
SBI
ones.
Okay.
New India Assurance.
But ICICI Pru was also negative on the listing day.
On listing day, but post that it gained. Yeah, I remember that.
So New India, General Insurance, and SBI Life, the 3 of them are trading sub the issue price, and that's quite a number. But yeah, suffice to say that either of the counts, even if you discount the listing day, and people would argue that, hey, what if I was an IPO investor? Still 14 out of 32 have given negative returns.
Yeah, it just goes to show great year for IPOs, not necessarily a great year for IPO investors, especially towards the tail end of the, sort of the IPO cycle this year, where we saw, I think, some issues come in. A crowding of insurance issues in a very short period of time, so it must have led to some investor fatigue. B, some fairly aggressive pricing, as the market has been pointing out for many of those issues. Yeah, so many of them are very rather expensive, especially for a space that's not very well understood or discovered, right? Insurance. Yeah. And then third, I think some degree of fatigue as well with some of these companies, right? So the best performing in all of this would have been what? Shankara Building or Avenue?
Shankara Building. Considering the closing day on listing price till now, it's Shankara Building.
That's done
and
the
then
best,
Apex. It's neck to neck, 132, 130.
And Avenue Supermarts?
Avenue is 72% from the closing price on the listing day till now.
Yeah, but from an issue price?
Issue price, it's up around 170 to
250%.
250%.
Yeah, sorry,
250% from the issue price. 268% to be precise.
268.
So they would be the standout there.
They would be the standout?
From the issue price, they would be the standout performer, yes, I would believe. Shankara Building is about 219%.
Okay, so not much of a difference in that sense, yeah.
But just to corroborate the point before we end this discussion, the last 6 IPOs, if you take Reliance Nippon as well as giving flat returns, have given negative returns.
Yeah, wow.
The last 6.
All right, great insights. Thank you, Sameet. That's how the IPO year has been as we head to a close. Yeah. That's all we have for you on First Word this morning.
Yes, indeed. But lots more on the show today. Quick programming note as well. Geoffrey Dennis, Head of Emerging Markets at UBS Investment Bank, will be joining us from the annual UBS India conference at 9:30 a.m. today. You can't afford to miss that discussion. But full tilt towards the day straight today. Let's take a look at the derivatives pocket to start off with. Navneet Saluja is standing by with the FNO setup. Navneet, good morning.
Good morning, Neeraj. Well, some respite as Sheikh's Nifty today morning is showing some bit of green tick. Let's see if you can see a bit of recovery coming about. But yesterday was the third straight day when the markets fall. And if you go by the benchmark indices, futures of Nifty and Bank Nifty are usually the most active. There has been long unwinding, which we've been seeing. So on Nifty, open interest was down as much as 2.5%. But watch out for the premium. We've been highlighting for you in the last 3 to 4 sessions. Premium has been hovering between that 40 to 45 points. And we're waiting for premium to contract a bit to see a bit of recovery coming in for the markets. Bank Nifty also saw a bit of unwinding. Open interest was down almost 1.5%. The premium was up almost 100 points for Bank Nifty. It did breach its key support level of 25,200 yesterday, but managed to close above that. The India Volatility Index, though opened on a very tepid note, but finally closed with a green tick once again. This was the third straight session when it closed above the key level of 14. Let's look at the Nifty PCR ratio, which has been falling because of higher call writing which has been seen in the markets. Nifty PCR fell to levels of 1.13, and similar was the case for Bank Nifty PCR. That too fell to levels of 0.94. Clearly, there's been fresh call writing that one is seen every day, and the put writers yesterday ran for cover, especially the 10,300 put writers saw shedding of almost 9.5 lakh shares, and 10,100. Now, this is pretty interesting. You're seeing 10,100 call adding open interest addition, and 10,200 added the most, almost 17.5 lakh shares. So if you go by the premium on these strikes, 10,095 to about 10,250 is the range in the near term that one is looking at. What are the FIs doing then? Clearly, they've been cutting down their long positions in the last few sessions. If you go on the index futures side, yesterday, almost close to 14,000 contracts were covered, and they created fresh shorts of about 4,000. Overall positioning, now that's a very key data we've been highlighting. When we started this series, they were 70% long on index futures. That ratio has come down to almost 49%, which is telling you they're cutting down their longs and they're creating fresh short positions on the index futures. So in case if there is any sort of recovery which comes in the market, there are shorts in the system, so there can be a short covering rally which can come about. Let's look at the index option side. They covered their long positions. Clearly, they bought more of puts and wrote more of shorts. So that's telling you now there are net shorts on the index, on the FNO side, be it index futures or also on the option side. Overall positioning, they've bought more of puts and they've written more of calls so far. Now, that's the positioning by the FIs. Right. In terms of key stock futures, watch out for Indo Count that went up in the second half of the session, and also Reliance Capital, which entered into the ban period. Back to you guys.
Well, watch out for all of these. Thanks a lot for that, Navneet. Abhijit Phatak, Director at Definet Solutions, joins us right now on the show. Abhijit, good morning. It did crack below your band that you were working with, but we'll start off with a slight bit of positive. How would you trade the index today?
Good morning, Neeraj. I would be looking at 10,200, 10,220 on the Nifty futures, which was a gap yesterday. So as long as it is trading below the gap, it will remain weak. So I mean, if it goes towards 10,200 in the first hour, one can short it with a stop loss about 10,220. And Nifty can be carried as a long only if it closes about 10,220. Otherwise, it can remain in this period. But I don't expect it to break 10,100, which was around that Diwali day low, more trading. So it might remain sideways between these two ranges, I mean these two levels, 100 and 200. But above 10,220 close, it will be bullish again.
Okay, so would you initiate a long into this, or would you wait for that level to get crossed?
If it comes down towards 110, 120, like near yesterday's close, it will be a good long with the stop loss below 10,100. If it goes towards 10,200, it will be a good short with a stop loss of 10,220. So it might be range bound for the day. If it just shoots up about 10,220, then it is a clear long once again.
Okay, what stocks, Abhijit, would stand out for you?
One stock which is showing quite a bit of strength is Ujjivan Financial again. I mean, it is chart-wise, it is still in a range between 370 and 395. So whenever it comes to the lower side of the range near 375, 377, one can buy it with a stop loss of 372. And it goes back towards 385 as the first target and 392 as the second target. And if it closes above 395, then it will be a very bullish breakout for the stock. It can head towards 430 also.
Okay, Abhijit, we'll leave it at that. Thanks much for taking the time out and joining us today and giving us your perspective. Quick tilt towards the commodity markets as well, which I presume are trading weak, but Pradeep Johnson will all the details and to take the show forward. Morning, Pradeep.
Good morning. Some recovery here and there, you may say, like gold is actually holding steady after the numbers that came out. The economic data was kind of mixed. US dollar index has stayed below 94, but bond yields have fallen a bit, at least at the long end. That is the 10-year or 30-year yield if you're looking at. And consumer price index, in fact, kind of moved down for the full year. If you look at it, the CPI is now 2% versus 2.2% for the last month. So that's kind of a respite, because rising bond yields are usually a bad news for equity markets. If you look at crude that we have been watching, crude still remains under pressure. Now you have inventory data that has came out, and inventory has in fact added 1.9 million barrels over last 1 week. That was the week to November 10th, and that's again kind of putting pressure on crude prices that remain low. If you look at sugar, this is one commodity which has corrected for second day in a row. On the other hand, you have steel, which is trading low for the second day. Zinc and copper also trading low for a second day, but aluminium has kind of managed to bounce back from recent lows, a small bounce, 0.5% or so at this point of time as we are speaking. So that's the trend world over. Commodity prices, not a big move like we had yesterday. That's one cue we can say.
Touch wood. Let's wait and watch what happens during the course of the day. But just bring up what the rest of the world is doing, bring up what the SGX Nifty is doing as well. Just a bit of an uptick from where it was. But you would assume, I mean, leave Shanghai out, assume a bit of green in the session, so a bit of a relief rally or a pause that we might see on the bourses today. Let's wait and watch if that lasts. But getting our fundamental expert on board, T.S. Harihar joins in with his thoughts on the markets. Good having you, Hari. Thanks so much for joining in.
Thank you.
Last few days have been nervous. Do you expect this to continue, or this is about the drawdown that you would see? Because, well, in percentage terms, it's kind of approaching the drawdown that we saw in the month of September.
See, broadly, I think the worst could be over, because apparently a lot of fear was built into the sharp rise in oil prices, plus the rise in geopolitical tensions between Saudi Arabia, Yemen, Lebanon, etc. I think while the geopolitical tension may still continue, oil apparently seems to have stabilized about 64, and I think last few days the oil prices have been down. So I think the global risk apparently seems to be under control. The data that has come out yesterday, I think US inflation is up, which is a good sign that growth could be coming back. Consumer spending is up in the US. I think all this should be positive, and I would believe that probably the Indian markets also should take a support somewhere around these levels, consolidate for a few days, and then actually resume their up move from these levels.
But yesterday we saw a lot of intense selling, especially in the last hour of trade in several mid caps, kind of led by ADAG Group. How do you look at that?
See, I think it was a lot of concern over stressed companies, especially companies who are sitting on a lot of debt. So I think we did see some selling in the entire ADAG group, especially after the default on the dollar loan that Arcom has done. There has been some amount of a negative, kind of a sentiment across the ADAG. So there was selling across infra, Reliance Capital, I think Reliance Defense, the Reliance Nippon. I think whatever ADAG shares are there, we saw selling across all of them. And that actually spread to the other stressed companies. So we saw selling in Videocon, we saw selling in JP. So I think it was more of very specific to highly debt-stressed companies. I don't think it's a market-wide trend that we can decipher that as.
One that you have mentioned is Suzlon, and there is a news report that there is probably a lockout at one of their plants.
Yes.
So I don't know whether the market knew about it yesterday.
See, I'm not sure because I think the news came out post markets, but I would believe that it was largely an extension of the stress play. Because, while Suzlon probably is trying to get its debt in order, the big challenge for Suzlon is that in the last 6-7 years, the best days for alternate energy are kind of gone. And with oil about $65-70, fresh investments in alternate energy are not going to come. Unless oil gets back to $90-100, you're not going to see the kind of surge in fresh investments into alternate energy. So that is negative. And I think the unfortunate part for Suzlon was during the best period for alternate energy between 2009 and 2015, Suzlon was deep in debt. And so it really couldn't capitalize on the opportunity. I think that could probably go down as the missed decade as far as Suzlon is concerned. So Suzlon, yes, we have been negative. And I think while the selling may have nothing to do with the news of the plant shutdown, I think it is largely because stress is something people are not comfortable with now.
If we just look at the large cap pocket, and before we get to our research team, I thought the stock that stood out yesterday was also Sun Pharma. Consistently under pressure, now nudging 500 yet again.
Yeah.
What does one do here? Large cap pharma. I mean, Lupin, yes, there is news flow to back this move. Sun Pharma.
It's very interesting. I was just seeing the market cap charts for pharma companies. Lupin used to be number 2 in market cap about 2 years back. Today, I think it's number 6 or something. But I think that apart, Sun Pharma seems to have some very serious problems as far as US growth is concerned. Because, we have seen a company like Cadila actually growing their US business by 66% in this quarter. During the same period, Sun Pharma has seen a 44% downtick. So I think there are some serious concerns. One of the largest products is going off, I think, going out of that the patent list. So I think Sun Pharma has some serious problems in the US market. They really don't have a big exposure to the non-US market, so that's a worry for Sun. But I think probably the problems began with Ranbaxy, and I think that's kind of continuing till date. So I don't see any immediate respite as far as Sun Pharma is concerned.
Okay, I guess that means that it's a no from Hari's end, at least, for people who might want to bottom fish. You don't quite know.
No.
Okay, let's also take a look at some results that were posted post market hours, and also some key stocks which could be in news today. And our research team, Johnson, in full strength to talk about all of these and more. Shraddha, Darshan, as well as Agam join in with what should you keep at the top of your mind. Shraddha, ladies first. Let's start off with you.
Among the stocks that we are tracking, CRISIL, they are going to be buying a company called Pragmatic Services for about 56 crores. So it's a relatively smaller acquisition. What does this company do? They provide software for business intelligence and analytics, and their FY17 consolidated revenues were about 17%. So it values the company at about 3 times its revenues. You also have Suzlon, where according to a Mint report, their O&M arm is looking to sell about 40% stake to raise about $250 million. The report says that they're already in talks with various global PE funds, and all the money that would be raised would be used to repay Suzlon Energy's debt. So keep an eye out on that name. Federal Bank, you have a PTI report which says that now they're eyeing entering into the mutual fund business, and additionally they're also looking to divest about 26% stake in their NBFC arm to raise capital. You have Atlanta, where the company has said that NHAI has wrongfully terminated an agreement for its Gujarat projects, which was under its SPV, and they have invoked arbitration proceedings for the recovery of damages. So some of the names Neeraj to look out for. Nothing much that's interesting apart from Suzlon maybe.
Yeah, and we just discussed that one. Thanks a lot for that, Shraddha. But anything interesting in the results that came out post-market hours?
So I think TD Power will stand out. A couple of numbers that came out. Let me start with Wonderla Holidays, which it actually met estimates. There's nothing much there. Revenues were up almost, it was flat, up 1%. Profit was down almost 39%, given the fact that tax expenses were much higher. But strong growth on the EBITDA front, 20% growth on the EBITDA margins coming in at 22.5% versus 19%. Care Rating came out with numbers. Revenues were up 12%. Profit was flat. EBITDA was up close to 11%. Margins coming in at close to 73% versus 74%. So that's also pretty flat. New India Assurance, good number. Gross written premium was up almost 12% for the company. PAT was up almost 200%. The combined ratio improved to almost 112% versus 124%. And the solvency ratio at 2.24%. 2.24 times. TD Power was the standout, very strong set of numbers. Revenues up 20%, profit up almost 400%. It's coming at 5 crores on a very low base. EBITDA up 500% on cost controls and EBITDA margin at 7% versus 1.5%. So this probably will be the stock to watch today.
Okay, do watch out for all of these as well. Some interesting names to watch out for. And Agam, some brokerage notes as well.
Yes, so Neeraj, we've had a little bit of confusion when the GST rates for restaurants have been cut from 18% with input credit to 5% without input credit. So we have some brokerages which revisited some of these restaurants, and we have notes on Jubilant Foodworks. So they spoke to the management, and first one is on CLSA on Jubilant Foodworks. They maintain their buy with a price target of 2,200, and they say that the menu price will see an effect of as much as 6% hikes, and based on that, they do need to watch out for customer reactions, but for now they are maintaining a positive stance as far as Jubilant Foodworks is concerned. And again, moving on to Deutsche Bank as well, they also maintain their buy stance with a price target of around 1,775, and they say that again when it comes to mitigation of potential margins headwinds, this is due to the impact of stranded taxes, and they're also saying that this remains a topic in the consumer discretionary space. So while both these brokerages have maintained their price targets, we'll have to wait and watch what kind of reactions the customers have when it comes to price hikes in the menu.
Yeah, let's wait and watch. We dined yesterday at a restaurant downstairs. The good part was, I mean, I didn't know the previous bill, right? So I just looked at the CGST and SGST, and it was 2.5, and I was happy. Yeah. So I don't know if people really remember what the previous price was, but yeah, let's wait and watch. Maybe I'm an exception to the rule. There are a lot of people who probably remember that. I know Darshan's Twitter account was flooded with messages and replies to the bill comparison, and a lot of people said, oh, it's a scam, so on and so forth. You don't quite know if that is indeed the case.
Yeah, we're trying to get the management, so I think that's the best point to get some clarification.
Yeah, let's wait and watch. Thanks a lot, all of you, for joining in today. Hari, have you dined out recently, or rather yesterday, post the GST rates coming off? And more importantly, I mean, what's your view on a Jubilant or a Westlife, or I mean, even a specialty restaurants for that matter?
See, I think this 5% cut is in fact a very good opportunity for these companies to make a small hike in the book price as far as their their items are concerned. Because what happens is when you go to dine with your family, you really don't worry about 100, 200 rupees here and there because of GST. You just pay the overall bill. I don't think that any of us really checks the specific items. So I think if these individual items are probably hiked by about 5%, the overall kind of burden on the customer is the same. I think these companies are going to stand to benefit in the end. So, we do like the restaurants, especially specialty, Jubilant. And, the net effect is that the government is going to get less, and the individual, the company is going to get more. And the issue about this input credit is not really very valid, because as far as restaurants are concerned, their net GST after input credit was supposed to be about 11 or 12%. So they're still paying much lower at 5%. So I think, in a way, to an extent, these restaurants will stand to benefit because of this. And if they're going to hike the price, then I think they are taking away kind of a piece of what the government is getting in the past.
So what's your top pick? You like this segment, right?
We like specialty. I think specialty seems to be one of the good picks. I think we have a good mix of restaurants. If you walk into any specialty restaurant, you find it full most of the time. So I think
haven't done well as a stock, and the earnings haven't quite participated, Hari, to be honest.
You're right. I think there's been a lot of investments done. So I think a lot of capital costs have pulled this down. They've been expanding quite aggressively in the last few years. So that could probably explain that. But if you look at the stock prices in the last few months, they've done well. I think from about 85, 90 to 120, there has been a sharp moment. But I think the good times for these kind of restaurants could start from here on.
Okay. And if you look at some more number, like Darshan was also mentioning, TD Power is probably one interesting number over last 4 quarters. If you look at it, this second time that company has posted profit. Last quarter was a big loss. Revenue growth at 20% is decent. What's your call on this one?
See, I've been tracking the stock for quite a few quarters. It's very erratic. I think that's a big problem with this company. It's very hard to take a call, whether it's a sustainable profit, not sustainable. So we would probably hold on. I don't think we'll be too positive because, let's see a few more quarters. At this point of time, I think the stock is a little too erratic in terms of earnings.
By the way, keep in mind, a power company that could well be in focus will be CESC, because apparently there is some move. The Uttar Pradesh regulator has cancelled the PPA for Chandrapur, and that might be a bit of a dampener on CESC. Let's wait and watch, though. We'll get in a bit later on to talk about this, but this could be an interesting stock to watch out for in today's session, Calcutta Electric. However, 8:45, that time of the show, when we get in our technical and derivative experts to speak about how are they approaching trade this morning. Let's start off with Chandan Taparia. He's Associate Vice President, Motilal Oswal Securities, joins us on the show. Chandan, good morning. Thanks for joining in. Let me start off, if you allow me, with the Bank Nifty, Chandan, because it's the weekly expiry day. And yesterday, while the indices, the Nifty and the Sensex corrected big time, the Bank Nifty held out on a relative basis.
Yes, very good morning. If you compare the Nifty and the Bank Nifty, Nifty is continuously making lower highs, lower lows from last 7 trading session and corrected by around 4% from 10,490 to 10,094 levels. But Bank Nifty has been consolidating in a range between 25,100 to 25,700 levels. Week on week basis, the Bank Nifty is down by only 1%, while Nifty is down by 2%. So comparatively, Bank Nifty has been consolidating and holding, but follow-up is missing. Because of that, it is not ready to move on higher side. So it is near to the lower band of the recent trading band. Yesterday, Bank Nifty Spot Index made low near to 25,166, and 5 days back, the similar kind of low was made, and then it witnessed some reversal. Looking at the option database, however, the volume weightage average is near to 25,350, so that will be the hurdle. But even after the decline, we have seen put writing at 25,000 and 24,900 strike. So because of that, expecting Bank Nifty to find support near to 25,000, while it may bounce towards 25,350 zone. So overall, expecting Bank Nifty to find support and consolidate between 25,000 to 25,350 level.
But today being the option expiry, Chandan, if suppose market opens as per our expectation flat to positive, will you be in a hurry to square off your calls or puts?
See, if market sustains near 25,200, 220, then I'll take new 25,200 call to play the 80 to 100 points up more in the Bank Nifty, or I'll initiate the bull call spread by buying 25,200 and selling 25,300 call. But in case if it sustains below 25,166 or 25,150, then I'll avoid taking long position and I'll be with direct 25,100 or 25,000 put.
Okay. Sameet Chavan is also with us, and Sameet will take in the index call in a bit, but it's that we really need to get the stock calls in at this hour. So let's start off with 2 stock ideas from your end.
First would be from the sell side, it would be Tata came, looks quite weak, and we saw some selling pressure in last hour. The stock has closed around its lowest point of the day, so looks weak, so we would expect this weakness to continue. Target would be around 688, stop loss can be placed around 716. Our buy call would be on Sun TV. Since last couple of weeks we have been quite a bit on this stock. The stock has already given a decent rally toward 900, but in last 3-4 sessions we have witnessed a decent correction, but 830, 825 seems to be a very strong support, and from here on we would expect some kind of bounce back. So we would expect the stock to head towards 890, which would be a near-term target. It can be bought with a stop loss of 806.
Okay. But before we look at the Bloomberg Edge, our regular feature, Chandan, quickly, what are your top trading ideas?
Yes, I have selected a couple of IT and the mid-cap counter. First here I am recommending to be with Infosys. Overall, the stock is moving in a range but finding multiple support at the time of decline. It has exactly taken support at the previous swing high, so resistance are turning into support. And in tech put writing at 940 strike is also supporting. So recommending to buy with a stop loss of 931 for an upside move towards 985 to 991. Apart from that, positive on the M&M Finance, even after the market pressure, the stock has given the breakout. However, it cooled off from higher levels, but still the breakout is intact as it closed above 440 level. So expecting positive stance to continue in the counter, one can buy with a stop loss of 437 for an up move towards 460 levels.
So Infosys and M&M Financials, these are the two calls that Chandan has given this morning. We'll moving on to our special segment, Bloomberg Edge, where Jayesh Khilnani tells us about a pattern that the Bloomberg terminal has thrown up. And today, Jayesh, which stock are you tracking? ACC, I guess.
Yes, that's right, Pradeep. I'm looking out for ACC because there has been an interesting chart pattern formation on ACC. So it is called as the bullish engulfing pattern. Now, first, let's have a look at how the bullish engulfing works and what are the theoretical criteria that you need to look out for. So you have to look out for two candles, which is the bearish candle followed by a bullish candle. So essentially means that a green candle should be followed by the red candle, and the second bullish candle should be bigger than the first one that you are watching out for. So essentially means that you have to see more green on the bullish candle than the red one on the bearish candle, that is. Now, the longer the body of the second candle, the better it is, or the more bullish you can, it means. And once all of these conditions are met, you don't need any additional confirmation. It means that there's a buy signal generated on the chart. Now, going to the chart of ACC, you can see that this is a 3-month chart, and if you see the last two candles, the red one is the first candle and the second one is the green candle, which has actually engulfed the entire body of the previous candle, the red one. So you can see that there is a bullish engulfing, which means that there is a buy signal which has come in on ACC. Another important point to note over here is that yesterday when the market was in the red, the ACC actually managed to close in the green, up about 1.5%. Shows that there may be underlying strength on the positive side.
Okay, many thanks for that, Jayesh. So that's the chart on ACC. Will not be looking all that great for the stock in the session today. Chandan, any thoughts on cement counters?
Yeah, in fact, SSC now finding some stability. In fact, on daily chart, it has formed the bullish engulfing and also forming a broadening formation that is just exactly opposite to its triangle. It has also managed to hold the support after the decline of last 7-8 trading session. So I think it may find support near to 1735, 1730 zone, and it can again head towards the recent high of 1835 kind of level. And apart from that, we have seen some buying in Ambuja, and I think if cement counter manages to hold, then India Cement might deliver a better return because it is now near to the lower band of the trading range, and with this range is working well from last 6 months. Every time it comes near to 162, 165 and moves back to 200 kind of zone. So if it sustains here and surpass 170, then definitely we can put a stop loss of 5 rupees for 20 rupees upside moving count.
Hari, what are your thoughts? Mid-cap cement, it's a pack which is kind of, the jury's out. People are split right down the middle.
No, I'm actually cautious in the cement space as a whole, because if you look at the mid-cap and the large-cap cement stocks, I think most of them have rallied quite sharply, right from an ACC to a Mangalam Cement. I think almost everyone has rallied quite sharply. And, the cement pricing power, which we normally use as the criteria for judging a cement company, I think that is nowhere close to coming back to the producer. So I think till that happens, we normally don't prefer buying these cement companies.
Oh, okay. Fair call. A lot of these stocks, though, I must say, from the recent highs have come off a bit as well, though admittedly nowhere close to the kind of rally that they've had. I mean, Asangi, for example, has rallied from 80 to about 135 odd, now at 120. So the crack is about 15 odd points or 20 odd points compared to the rally that we've already seen. But yeah, 10% over the last few days. They have come off a bit.
Yeah, and one interesting point about the engulfing pattern also is that deeper the correction after which that pattern appears, the rally upward would be as intense as well. So this one was an intermediate correction that we have seen, and so probably is bottoming for now, but we are not sure whether this will hold on. So that is something we'll see whether it can make a new high as well when it recovers. But moving to a new stock is New India Assurance that came out with the numbers, and I like the solvency ratio that has improved quite a bit from 2.04 to 2.25. The minimum threshold in India is 1.5, so this looks decent. Business growth also. Okay, the last quarter was not reported because it got listed now. This for the first time we are looking at the quarterly numbers. But what's your view?
See, I think a couple of things. If you look at the sharp growth in profits, it was largely driven by a sharp fall in underwriting costs. Now, whether a fall in underwriting cost is sustainable or not is something we'll have to see, because my understanding is a fall in underwriting costs can be a one-off. It is normally not a sustainable kind of an advantage. So whether we'll continue this kind of a profit growth going ahead is something that is doubtful. So that is an issue we have. I think on the solvency ratio, yes. At least what it indicates is that the company is earning more than it is paying out in terms of underwriting. So I think to that extent, it is good that the solvency ratio has gone up. But again, we have seen the company listing quite badly and performing post that. And that is largely, I think, more to do with the aggressive pricing that most of the insurance companies are. Because unfortunately, I think nobody has really understood how to value an insurance company, more because of lack of any, I would say, proper benchmarks for insurance companies. So I think it has been a case of aggressive pricing. So we'll have to wait for the froth to go off most of these stocks.
Okay. I want to bring up three charts now. One of them, Edelweiss is one, IIFL is other. Both of them are in news. And Motilal Oswal is the third one. You typically speak about this trio when you're speaking about these brokerage stock diversified in players. Look at the 1-month chart of Edel versus IIFL, which is corrected 5%, and versus Motilal Oswal, which too, I think from the highs that it had, has corrected. So about 7% down for Motilal, about 5.5% for IIFL. Edelweiss is holding out. It's and almost trading close to its recent highs or the lifetime highs that it is clocked in. And there's a QIP which is open at a price slightly higher than the price of 282. 285, I think, is the QIP price. What gives you a hurry? While they may all be clubbed as a pocket, each of them have their own speciality, right? Edelweiss, the ARC business is probably much different than the others. Yeah. Motilal Oswal, probably the best in the asset management within the three. And IIFL has its different core strengths, including the wealth management business as well. So what do you choose and why? If you choose any.
See, frankly, as far as Edelweiss is concerned, I think what's interesting is that their ARC is larger than ARCIL now. ARCIL, of course, was the pioneer in the ARC business, but today Edelweiss, ARCIL and the ARC business is larger than ARCIL. So I think that's a very interesting area, and I would bet heavily on the ARC business. Okay. I think if you are looking at probably the next 5 to 6 years, and I think it's going to take that much time for the entire asset quality issues to get sorted out, I think ARC could be a very big business. There are risks. I'm not saying there are no risks in the ARC business, but I think Edelweiss has shown a very, I would say, a smart execution tendency in the last 4 or 5 years. And if they can maintain that kind of execution tendency, I think ARC could be a game changer as far as Edelweiss is concerned. So purely from that perspective, we would prefer the Edelweiss stock among the three. I think IndianOpen could be interesting because they're hiving up their broking business and listing it separately. And it could create a new scenario where you have broking, which is probably, I think, 10%, less than 10% of their business. Probably growing very rapidly because we're seeing a lot of, I would say, flows coming into equities. And then there is a non-equity business, which is the primary business for all the three companies. And I think that is, again, it's a fund-based business and likely to grow. So I think, to me, all the three stocks look attractive, but given a choice, I would probably prefer Edelweiss over the others.
What about the new listing today? I mean, very quickly, would you, if post-listing, would you buy the 5 paise business?
Not exactly, and I would still prefer IndianOpen for the non-broking business rather than the broking side of the business.
It's loss-making, remember.
Yeah, but most brokers are.
When has that bettered investors, frankly, in the recent past? But yeah, that's a valid point.
Okay, so we are all set for the market open and pre-open signals. If we take from STX Nifty, we'll probably open a bit higher, 15 to 20 points higher on Nifty. STX is quoting at 10,165 to 10,170 levels right now, and that is the cue we are taking. But I think all eyes will be on the ADAG, Suzlon and GMRs of the world that really crashed yesterday.
Yeah, you bet. I mean, I think everybody will be, Pradeep is so right. 7 ADAG group companies, all of which cracked over 7% yesterday. Some even double-digit losses and failed to recover intraday either. So intraday too, rather. So let's wait and watch what happens to those stocks. About 28 seconds. Also, as we said, watch out for Indian Hotels. We haven't quite discussed that counter as yet, but it's going to meet a clutch of institutional investors. So do watch out for that. And Edelweiss as well. I mean, the QIP price is very close to the current price, but do watch out for that as well. But here's what the rest of the world is doing. A fair bit of green. There's SGX Nifty 2 about 22 odd points. So relief start, if you will, that we'll have at the market open. The question mark is whether that can hold on or no. That remains to be seen. But these are the first trades. maybe not a 1% uptick, but you could well have about 142 odd points on the Sensex. That is entirely plausible, even though the SGX Nifty is not indicating such a start, but you could have a 100-point start on the Sensex for sure. Let's wait and watch. Bring up ADAG or the Anil Dhirubhai Ambani Group stocks. Those are the ones that were at the center of the storm yesterday at the broader end of the spectrum. Reliance Capital, Reliance Power, Reliance Infrastructure, Reliance Nippon Asset Management, RCom, which actually moved down to the single-digit levels yesterday as well. Let's see. I think there's a semblance of sanity out there. Reliance Nippon Asset Management would be the principal one, quite frankly. That one, let's wait and watch if it recovers from this near its issue price levels that it touched, or in fact dipped below in trade yesterday. Also, what went down quite strongly yesterday was Sun Pharma and the commodity boys, Vedanta and Hindalco. I think all eyes will be out on these big boys and whether they recover a little bit or not. Lastly, the OMCs, which put up a bit of a fight yesterday, BPCL in particular. Let's wait and watch if that indeed moves about. For now, though, it's a quiet start.
Federal Bank is one. If you look at it, up around 2%. The bank is actually planning to sell stake in one of the subsidiaries, and that could be the reason why stock is up. Central Bank has the open, at least in pre-open, is trading with gains of 4%. PC Jewelers have moved up by 3%. So these are some more movers. Actually, Madison Sumi is up 1.5%, and NBCC is another stock which has seen some buying so far in trade today. TVS Motor, on the other hand, is scoring down 8%. I don't know what's the reason. Not much volume, though. We'll probably wait for it to stabilize. But RCom is all set to open below 10 rupees.
Okay, let's talk about what the brokerage is saying. I mean, I think the brokerage calls are on all stocks, but for these and Suzlons and the JP Associates. But let's get in Sameet Sarkar, who's got the big brokerage calls for the morning. Sameet?
So on the brokerages, first we have yesterday Deutsche Bank on the second quarter earnings review. Now, according to them, in the second quarter, Nifty 50 companies, revenue, EBITDA and net profit increased by 10%, 15% and 12% compared to last year. According to the brokerage, in the second quarter reflected the impact of destocking ahead of the GST implementation. Though there was a revenue growth momentum, though the revenue growth momentum was muted, but in the second quarter, margin improvement was something that stood out. Now, the sectors which gained in the second quarter included consumers, exporters and utilities, and the sectors which declined in the second quarter included financials, metals and energy. Now, post the listing, Deutsche Bank hiked the target price for companies like L&T, GAIL, Infosys, Ambuja and M&M, and they have cut the target price for Axis Bank, SBI, Tata Motors, HCL Tech, Lopen and ITC. Okay, Sameet, many thanks for that, but have to go across to a management which is joining us. Westlife Development, Amit Jatia he needs no introduction, frankly, joins us right now on the show. Amit, good morning. Thanks so much for joining in. This is as much a social call as it is a business call. Amit, you will appreciate this. But yesterday, our Twitter accounts were flooded with queries about how is it that restaurants can charge the same when the central sales could stack, or the GST rates have been reduced. Now, can you throw some clarity here? Because as we understand, the input tax credit is no longer available to you.
Absolutely. So basically, of course, we are delighted that the tax has come down from 18% to 5%. But that came with a very important rider that basically input tax credit will not be available to restaurants. Now, you recognize that there's a spectrum of restaurants. Many are the small, unorganized guys, while there are larger chains like us that operate in the country. We have invested over $200 to $300 million to set up supply chain in India, and they pretty much use this supply chain to buy product and pay tax of 12% on every purchase, 18% in many cases, and so on and so forth. Pre-GST also, we were getting input tax credit on pretty much everything that we were doing. And now with input tax credit going away, obviously that has become a cost for us. So the real reduction is not necessarily from 18 to 5, at least for the organized players. Essentially, our cost has gone up by about 10 to 12%. And therefore, for us, there's a very marginal difference in this whole shift. And what we have chosen to do, given that, many of our products like Aloo Tikki, with or without GST, have been value for money for the consumer at very low margins for us at 30 rupees starting point, we've taken some of our iconic products like the Maharaja Mac and brought the price down from 200 rupees to 150, which is a 25% reduction rather than a 1% reduction. And we've chosen to give our customers on our iconic products the value and pass on the whatever little small benefit that we've got out of this. So we feel that overall, of course, this should help sentiment, and the overall restaurant sector will definitely see a gain. But for people like us who use organized suppliers...
Net, you mean to say that... Net, you mean to say that with shifting from 18% to 5%, actually your tax outgo has come down and you have benefited and passed on that?
We've benefited marginally because the cost of input tax credit for us is 10 to 12%, and the marginal gain has been passed on through the products that we felt the consumers were asking for. So that is how we've been able to do it. Also recognize that our pricing is 30 rupees, 35 rupees. It's already value. Sure. And with or without GST, we've ensured that the consumers get value at McDonald's.
No, which I'm sure you have, Amit. My question is, though, that this would be different for different restaurants. For you, the input tax or the quantum was maybe about 12%, as you mentioned. For some other restaurants, that could well be slightly less than 10%. It could well have been more than 13% as well. It's difficult to gauge that.
It could be. As far as we are concerned, because we use supply chain, and see, pre-GST, we were getting input credit for all the purchases we were doing on food items as well. And given that at McDonald's, we use registered dealers and we have this supply chain that we've set up, the cost of tax is very high on us. If you look at real estate, every time we rent a property, out of the 265 properties, almost every one of them is rented. So the impact of the service tax of 18% on the rent, it's all in our P&L, for which we were getting credit earlier. And now that the credit is taken away, that is the impact that is there on our P&L. It's a real fact.
So net, it's been a net neutral move, right, Amit? I mean, what's happened is that the tax income or the GST income for the government may have gone down, but resultantly the input tax credit that which they had to pay to restaurant chain like yours has also gone down. So for the consumer or for you or for the government, there has not been any change per se.
No, I would say that suppose I own a property and I'm not paying any service and rent and service tax therefore, and if I'm buying from unregistered dealer and my turnover is small, I think those guys definitely are going to benefit significantly from this. Okay. So my view is the spectrum of the restaurant industry is very large. You'll see roadside vendors all the way up to organized chains like us, and therefore the gains are going to be different for everybody. I think overall, from a big picture point of view, it's a great move because the consumers get the benefit. But for organized people, losing input tax credit, I feel, is a very huge negative. And the net fine, the government has ensured at least we don't lose out. And yet what we have done is that we've ensured that like a Maharaja Mac, our iconic product, that's on television all the time, we've been able to bring the price down by 25%. So we want to support the government. We want to make sure that, these benefits to consumers increase consumption. And I guess we've done our part on that.
Okay, thanks a lot, Mr. Jatia, for taking time out for us this morning. So basically, the high-priced product has gotten cheaper, but if you are buying Mac Aloo Tikki, you haven't really benefited as a consumer. That's the takeaway from this interview. Well, let's move forward and look at what ICICI Prudential Mutual Fund they have tilted towards private financials in October. The fund increased exposure to HDFC Twins while cutting down its stake in State Bank of India. Jayesh Khildani is standing by with what the fund has really done over the last 1 month. Over to you, Jayesh.
Pretty very interesting trends coming out from this mutual fund house analysis that we've been doing for the past 2 days. Coming on to ICICI Prudential, India's largest AMC, in terms of where they have increased stake, this is extremely interesting because all 5 companies that you see on the screen are Nifty companies. Now ITC, they've added nearly 1.5 crore shares. Remember, in the month of September also they added nearly 3.5 crore shares. So that is a total of 5 crore shares added in the last 2 months. HDFC Twins, of course, they've added about 50 lakh shares, and Infosys is the other interesting one where they added nearly 22 lakh shares in the month of September. Also that was close to about 28 lakh shares, so nearly 50 lakh shares getting added in Infosys. In terms of where they have decreased stake, this also has a trend. Most of these are commodity linked names, so you have Coal India where they've sold off about 1.1 crore shares. SBI is the only private sector bank. Yesterday we were analyzing Reliance Mutual Mutual Fund, and SBI featured in that list too. So they sold off about 86 lakh shares. Petronet, LNG, Castrol and Tata Steel, the others that where they have reduced stake. In terms of where they have bought fresh positions, have a look at that. Over here, you will be able to see that the Bodal Chemicals is the one which is in focus. Yesterday, we were seeing Reliance Mutual Fund. They too have initiated position. So, some trends emerging in the specialty chemical space. NLC India, they bought about 1 crore shares, and they subscribed to Godrej Agrovet and IEX in their IPO. Bought about 7.5 lakh shares, and IEX 1 lakh shares added over there. In terms of what they have sold, this is a mixed bag. Birla Corp, they sold as much as 3.3 lakh shares. Indoco Remedies goes out, so does Bank of India and Supreme Industries. So that's the key takeaway from the ICICI Mutual Fund portfolio rejig.
Okay, that's interesting. Thanks a lot for that, Jayesh. Bought into some index names. Remember, ICICI has had this history of making some fairly amazing contra calls. They did it in telecom. I think they did it in the metal space way back about 3 years ago. Reaping the benefits. No contra calls here, quite frankly. Pretty much.
This could also be kind of an adjustment, You have a portfolio, whatever appreciates disproportionately, you book some profit, and whatever falls, you add to it. Like adding ITC and pruning Bank of India and SBI could be part of that strategy.
Yeah, I mean, and different, different schemes might have different requirements. Difficult to read into 1 month changes, quite frankly. But no, par for the course, I would presume. But minutes away from the market open, let's tell you all that you need to know to stay ahead in trade today. Ahluwalia Contracts, Gati, Honda Seal and Matrimony.com will report numbers today. Watch out for these.
Strong results by TD Power, New India Assurance, while Care and Wonderla reported in-line set of numbers.
Metal and rubber stocks will be in focus as base metals and rubber continue to drop on the Chinese commodity markets today.
Well, 5paisa Digital listing on exchanges. IIFL demerged 5paisa Digital, undertaking into its fully owned subsidiary 5paisa Capital in 2016.
11 stocks in F&O ban. New additions are Jet Airways, Reliance Communications and Reliance Capital, while HDIL and Jain Irrigation exit the F&O ban.
Indian Hotels to meet T-Rowe, also Wellington and other investors today, while the shipping and Crompton Greaves to meet marquee investors. So these are some of the stocks that will remain in limelight. Well, ADAG stocks, if they have moved into ban, would that kind of provide a support, at least looking at the kind of cracks we had seen yesterday? Well, so you can't short them any further.
Yeah, except on an intraday basis. But yeah, Pradeep brought up an important point. Let's just quickly look at the ADAG group and how they've settled post the pre-open rates. Reliance Communications slated to start off in single digits, but the others should come up. Reliance Capital, Reliance Nippon. I think it's a flattish start that we'll have today. Sameet Chan, just before we get in the top trades, as committed, a quick call on the index. What would you do today?
See, since last 3 days, we have been witnessing correction, and the Nifty has managed to slip below 10,300 first, which was acting as a very strong support, and then below 10,200 as well. So considering yesterday's activity in 10,200 call, a lot of call writers were quite active, and the kind of open-ended addition that we saw yesterday, so that clearly indicate that any bounce back toward these levels is likely to get sold into. So we would maintain our strategy, sell on rise. We expect Nifty to slide toward 10,050, 10,000 next few days. Any minor bounce, probably 25-30 points from current level, would be a selling opportunity. Stop loss can be placed around 10,220.
Okay, let's nail it down to that one stock trading idea for the day. Chandan, if you had to choose one stock today to trade, which one would that be?
We have discussed about the M&M financing fee. I have one more idea, that is Jubilant Food, and I think this stock can really do well. It's trading here to its recent 52 weeks high. We have seen surge in the open interest activity. So here I'm recommending to buy with a stop loss of 1685 for an upside target towards 1775, then 1800 levels.
Your top call for the morning? One top stock for the morning.
See, we recommended sell in Tata KM, buy in Sun TV, but I would like to add one more, which would be an option segment. One can buy Tata Steel 680 put option, which is trading around 13-14 rupees for a target of 27. Stop loss would be around 9 rupees.
Okay, Jaman, stay on. So much more to talk about, but let's get you the market open this Thursday morning, 16th of November. We'll start off on a positive note. 10,168 is what there's, About 0.25% is what the pre-open rates seem to be suggesting as well. Let's wait and watch if that happens. All eyes, yes, will be on the Anil Dhirubhai Ambani Group stocks, the trading moves today. But quite frankly, beyond that universe, there is a set of stocks which could be interesting to note today. So let's wait and watch for those. But these are the first rates. And about 0.33% or slightly over that for all the key indices. No, not so much for the Nifty Bank, but keep in mind the Nifty Bank didn't correct as much yesterday. So holding out on this weekly expiry day, the Nifty Bank too is starting off in fact now about 0.33%. So identical start for all the three key indices. Let's bring up the heat map. The broader markets too, I would presume, would have started off on a similar note. But let's get the heat map and try and show you what's happening to the index constituents. Fair bit of green. This is a mirror image of what was there at close yesterday. A lot of red. Today, a fair bit of green, but it's only at the start. I think there's nothing too noteworthy, but for the fact that there's a bit of a bounce in some commodity names and a bit of a bounce in Bharti Infra. And no big losers. I think that's the key thing. So today at the start, well, frankly, we've moved even higher now. So about 0.5%, nearing the 0.5% mark, 150 odd points. It's actually not a bad start at all. And yeah, led by the bounce back boys, you would presume. So ONGC, Bharti Infra and the commodity names, these are the ones which are doing well. What about the broader end of the spectrum and some specific stocks to note? Firstly, in the F&O ban, a few stocks, or rather, let's start off with a strong Q2 that we've seen for New India Assurance. And that one is about 2.5 odd percent. So a good start for this one in the session today. Then stocks which TD Power 2, again, one stock that Pradeep was referring to as well, 212. Margins have expanded YOY basis, so really good going for that one. New in the F&O ban, but that has failed to revive any kind of animal spirits in these names. So RCom, 3% off. Reliance Capital, that is the interesting one. It's had a series of falls and down about 1.5% yet again. Jet Airways is separate. So let's get all the ADAG group companies. RCom and RCap are one. Let's get the other ones. Reliance Nippon AMC sees some buying. Some people would argue rightly so. Reliance Power, no, not too much again. And Reliance Home Finance, which now cracked to 65 or 66, continues to slide lower. So suffice to say, not too much of a respite for almost any of these group companies, but for Reliance Nippon AMC, which is marginally higher in the session today. Not the best of starts, Pradeep, for these stocks.
Look at some of the non-index plays. SAIL and Nalco stand out because there is no bounce in commodity markets as of now, whatever we have seen this morning. So this is a pure equity market play. SAIL had in fact corrected quite a bit in last hour of trade. I think it was down 6% out of which half of that actually came in the last hour. So it's kind of a bounce maybe. Manappuram Finance has opened higher, 2.5%. You also have Balakrishna Industries. This stock has been holding on even in a weak market, has moved up. Apollo Tyres is also doing well. So this could be a sectoral trend where tire stocks are trading strong given the correction in rubber prices. Suzlon, that we talked about earlier, is down 3.5%. Not really benefited by the news that they could be looking to raise some funds somewhere. If you look at other key stocks, well, I think Adani Enterprises is one which is trading weak, down 1.5%. So that's about the open. Nifty up 50 points, Sensex 150 points. Good start.
Well, bad start, Hari. Your prognosis seems to be turning out true. The question is, can this last? Difficult to gauge, though, I would presume.
Hard to gauge, frankly, Neeraj, because see, this market currently is quite sensitive to any kind of global triggers, and you never know whatever happens to oil, Middle East. Russia seems to be making all the right and wrong noises. You can never say, but I think at least the good news seems to be that there is a bounce in the opening, and whether it sustains or not, it's different. But I think it probably is giving an indication that the market is kind of bottoming out around these levels.
Okay. Great. Hari, I don't know if you track these companies, Apex Frozen Foods or some of the others. No, clearly you don't, but just look at the moves there while we mark some of the other names. Apex Frozen should come up because Sameet has been talking about it the last few days. This one is up another 5% today. Results came out day before. Yesterday had a strong move. Today starting off well as well. So doing very, very well for itself. And a company that we'll talk to a bit later on in the show, Automotive Axle. Strong numbers, was up 10% yesterday. Automotive Axle has another 3% today. So good start for that one as well. Hari, take a moment to thank you for joining us today on the show. Look forward to having you more often on this forum.
Sure. Thank you. Thank you very much.
Well, that's a lowdown of a bunch of names that you probably wanted to know. Jubilant Foodworks starting off about 1% higher, though I think Pradeep already marked that. Let's get in. On the market voice, Pramod Gubbi, he's Managing Director and Head of Institutional Equities at Ambit Capital, joins us right now on the show. Pramod, good having you. Thanks so much for joining in. Just wondering, what's been the feedback from investors across the world? You guys recently had this Singapore conference, if I'm not wrong, as well. What have you been telling clients with regards to the recent pullback that is seeing in EMs by and large in India too? And what's been the client feedback?
No, clients continue to be positive. In fact, foreigners have turned incrementally positive in the last 3-4 weeks, given the sort of stimulus measures we've seen from the government, which was sort of well needed to boost growth after seeing 5-6 quarters of slowing down in terms of GDP growth, and that had its own implications in terms of corporate profitability as well. So given where valuations were, it was badly needed in terms of a boost to the economy, and hopefully that will trickle down to earnings growth as well. Having said that, I think there are some geopolitical risks on the anvil, which can sort of flow into Indian fundamentals through the conduit of crude prices, just when the government is loosening its purse strings in terms of stimulating the economy. If you have crude prices running up, the ability of the government to boost economic growth by spending is naturally going to be curtailed. So that's something that people are watching out for. Other than that, it's very difficult to predict that risk panning out. The only hope is that, given how US shale oil has reacted in terms of supplies to every rise in crude, you can be hopeful that this crude rally is not going to be a runaway rally and will be curtailed at around these levels. But by and large, I think foreigners are incrementally positive running into it. They are watching some of the macroeconomic indicators very closely, particularly around fiscal deficit, current account deficit, and inflation. All three of these parameters have been fairly benign for India in the last 3 years, and all three seem to be sort of inching up in some ways. May not be so much the fiscal deficit. I guess people may not mind that going up, given the need of the hour is to boost growth, but it shouldn't come at the cost of inflationary pressures or the current account deficit increasing, again putting pressure on the currency. So it's a bit of a fine balance, but it's by and large on the balance it's more constructive.
When you are really facing that kind of a fine balance, which is kind of difficult to maintain, markets mostly correct. The action is on the negative side. What are you really expecting for next 6 months, given the kind of global and local macro backdrop you just mentioned?
Yeah, I think based on fundamentals, I think global growth has been fairly robust across the board, across developed markets and emerging markets. The only thing worth watching out for is, now that the big political situation or event in China is over, how does China play out its economic policies, particularly in terms of boosting growth, which has really helped commodities run up. Clearly China has driven global growth in some ways, and that'll be something to watch out for from a fundamental perspective, besides the geopolitical risk, which is hard for anybody to analyze. Locally, again, it's going to be the government spending. Hopefully, the sort of stimulus measures, the rate cuts in GST will also get back some sort of boost in terms of consumer spending. But in terms of markets over the next 6 months, it'll always be driven by flows and liquidity in such short periods of time. And flows continue to remain robust, particularly domestically. I think there's no reason to believe that'll go away unless we see a really sharp correction. But then it's a sort of a chicken and egg situation. You need a sharp correction for those flows to go, and you need flows to reverse for a correction to come. And particularly at a time when foreigners who have been selling in the secondary market for the last 10-12 months have finally turned buyers, and given the situation in Japan with Abe getting elected and Draghi following up with a fairly benign statement around QE in Europe, it's unlikely that the Fed will tighten anytime soon, at least tighten more than what the market is expecting. So even global liquidity seems to be fairly benign. So from a short-term perspective, very difficult to see markets taking a nosedive. At worst, you could see consolidating, but otherwise, you should see this upward move continue.
It's heartening to really hear that FIIs are turning positive after several negative months in terms of FII data, so to say. But what stories are they really liking, or what stories are you recommending at this point of time?
I think it's twofold. One is the hope is the same quality names which have been pumped up in terms of valuations. One would hope to see some sort of correction so that they become attractive again. But the other strand is about a portfolio reconstruct, where if we see spending around roads as the government Ratmala project has sort of started, you see interest going into areas like EPC and infrastructure in general. But also, if the PSU recap goes through, or rather more than if, it's when the PSU recap goes through, you might see funding being available for certain sectors which have been sort of constrained by lack of funding from the banking system. And those sectors could come into play as soon as those recap happens, and not just coming back into existence, but also can foresee a path of growth for them over the next 2-3 years. So you could see sectors like engineering, industrials, infrastructure, like I mentioned, potentially even real estate, seeing some money flowing into them away from some of the more expensive sectors which have held up over the last 3 years. Particularly, I think private sector banks facing the retail segment, and NBFCs could be at a loss here, where valuations are fairly punchy. At the same time, with the PSU bank recap, one could assume that the pace at which that they were gaining market share may not be the same going forward, and hence you need to see some sort of pullback in terms of earnings growth, as well as the earnings multiple as well. So you could see some sort of portfolio reconstruct happening in that way.
In your answer, Pramod, is a belief that PSU banks will start maintaining or regaining or not losing their market share almost immediately?
Yeah, it'll take a while. I think it'll take a quarter or two before we can see that. We should also wait and see for how the government goes about allocating that capital. All we know is, of course, every PSU bank will get enough to plug the hole that the NPA situation will create. By the time we see that, we should also see some sort of development on the insolvency issues, so that we know what sort of haircuts are we talking about. But there is some excess growth capital in that number that the government has come up with, and it depends on who gets that number. Our sense is some of the larger PSU banks will be up there to receive that, so that they can start growing. Now, in terms of their ability to pass it on to the financial system, I think some of the larger guys are clearly in a position to do that. Rather than saying that they'll start regaining market share, the best way to see it is the pace at which they were losing market share perhaps will come down, which is why I'm saying that earnings growth for a private sector bank facing retail or NBFC could take a knock a few percentage points.
I want to mark Rain Industries is down another 5% today. GVK Power is down another 2.5% today. So there's a bit of a correction that is creeping into some of these names which have moved up in the recent past. Watch out for those. And Religare is on a roll. The last 2 days, I think these two names, both Fortis and Religare, have had a bit of a respite. Religare in particular is up another 10% today. I don't know what Fortis is doing today. That should be interesting. Pramod, one question, I'm throwing this out of the dark at you, but this is not based on the coverage that you may have, but more based out of the experience that you may have. The kind of correction that we've seen in the ADAG group stocks, I'm again not asking you to comment on an individual name out here or give me levels or anything, but just the fact that a scare in one principal group company is leading the market to start painting some of the others with the same brush as well. what would your thoughts be? I repeat, this is not a question based out of your coverage area, so I'm not expecting you to give me a informed answer, but just a thought here.
Yeah, but we've seen that in the past as well, right? So when you have to, when you see distress in one asset, it sort of leads to contagion amongst related assets because there is all sort of related implications on the group in general, particularly when it comes to balance sheet issues where you could have cross holdings and stuff. In this situation, I'm not aware of the particulars, but we've always seen that it cannot be contained into one company. But at the same time, it also might give some opportunities where there are other assets which are fundamentally strong, but the market is sort of overreacting, and it could be available at reasonably good prices, provided one can see sustenance or those businesses continuing into the future. So once you make up your mind and you think the asset is strong enough, but it's been underpriced by the market, it could also throw some opportunities. It could work both ways.
Honestly, for a while there was no capital available, or for some other reason no transactions were really happening. But now we are probably in the season of recapitalization, where if PSU banks are getting capital from the government, Axis managed capital from private sector as well. So all these over-leveraged, distressed companies, whether or not in the NPA segment, do you see a lot of deals happening, and there could be upside due to that?
Yes, I mean, particularly in sectors like metals, which have been given a huge relief by Chinese economic policies, which have led to metal prices rallying globally, and that's also helped some of the distressed Indian companies, particularly in the area of iron and steel. We reckon there could be some sort of value emerging there. I mean, it's clearly activity is increased in terms of potential M&A, and that could clearly result in upsides there. As relates to, say, other sectors such as thermal power, one cannot say the same because we haven't seen the same sort of support coming in. You've had a relatively benign situation as far as power prices are concerned. You still have the state electricity boards, which aren't in a great position in terms of ability to purchase power. At the same time, you have renewables picking up. So while sectors such as metals, in particular steel, could see some upsides in terms of at least away from the distress that they've seen, some other sectors might continue to remain in distress. So you need to be selective in that way.
Interestingly, Bhushan Steel is up 5% today.
Okay, Pramod, on that note, we'll let you go. Thank you so much for taking the time out and joining us. I look forward to, of course, speaking to you more often. That's the Ambit Capital view. The markets, by and large, just very quickly, Bharti Infratel is bouncing back, Reliance is bouncing back. So two names that I spot on the large caps. I don't know if Pradeep is spotting more. Bharti Airtel too, incidentally, is doing okay. So telecom seems to be in a sweet spot today.
Definitely, and there are some more names like GEM Financial, some of the high beta stocks, Radico Khaitan, even JP Power Venture is doing well. So definitely, yesterday we spent a lot of time in our closing show highlighting how we are closer to probably important support levels. And it looks like, we were right.
Yeah, well, on the Nifty Bank for sure. Let's wait and watch if that indeed has some saving grace for the markets. But all three indices doing rather well right now. Take a short break though. Coming up next from the UBS conference, the head of emerging markets, Geoffrey Dennis, joins us on the other side.
Are we live?
authoritative and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
Just business news, we're news for business people.
Back with Indian Open right here on Bloomberg Quint. I want to mark Page Industries amongst other stocks, which is doing so well. That one is up another 4.5%. That's 1,000 rupees in a single day. And Page Industries is now at 24,000 rupees. This is a big move that we're seeing in the big boy. Doing rather well for itself. A couple of other names like Vakrangi, Jubilant, etc. doing well. The question mark, though, in the minds of almost everybody is all that's happening within the Middle Eastern region, what all that's happening within the central banks as well. What kind of impact could it have on the trade, fund flows into emerging markets? And will all emerging markets be dictated by the quantum of flows that would come in from the foreign institutional investors? That's the question mark that we pose to Geoffrey Dennis, Head of Global Emerging Markets, who joins us on the sidelines of the UBS India Investor Conference. Geoffrey, so good having you. Thanks much for joining in. You know, I remember a conversation that we had 3 months ago, and you had spoken about how geopolitical events, which were prevalent at that point of time, will not have a really big bearing on emerging markets. Now, that belief has been vindicated because we've not had a big market scare due to North Korea. There is a new one on the block, though, right now, Geoffrey, and that is the Middle Eastern tensions and the rising oil price. How concerned would you be about that for emerging markets?
I suspect that the Middle Eastern tensions themselves would probably not have a great direct effect on the emerging markets. Obviously, there is a scope for more conflict in the region. I'm not an expert on the region, of course, and yet we've had conflict in the Middle East, off and on pretty much for the last 6 years since the so-called Arab Spring. But you're right, I think, to focus on the risk to oil prices and what that could do in terms of the impact on emerging markets. Now, our view has been for a long time that rising oil prices tend to be a positive for EM equities as long as the oil price increase is driven by demand factors. Now, clearly, with the change in Saudi Arabia recently, there have been some concerns about oil prices that supplies might be restricted. And so were to see another spike in oil prices based on concerns over supply, I think that would be a negative for the asset class overall. But the best bet here is that oil prices will start to subside a little bit here into the high 50s. And that risk, I think, will subside with it.
Okay. Yeah, so let's wait and monitor the situation. And I think, that's probably the best thing to do. Geoffrey, what about your view on India? Because for the longest time that I remember, at least the last 6 odd months, you have been bullish on India. It probably is, if I'm not wrong, or it probably was amongst your top overweight positions in the emerging market. Does that still stand true? And is that the theme at the conference as well today that you would be telling your clients?
Yes, I mean, we still have an overweight in India within our emerging market portfolio, and so we will be talking about that to investors. Now, I think India is a good deal more complicated at the moment. I mean, the positive side is, of course, the market's had a very good year. It's outperformed in perhaps a year when investors might not have expected that to happen. We think that's got a lot to do with the money that's come into the market locally from players in the local economy who've been put off the property sector, for example, by the impact of demonetization in India. And then, of course, you've had the slowdown in the economy in the current fiscal year, which is causing some uncertainty about what the growth story will be like in India for the long term. Now, our view is that the economy will recover to over 7% growth in fiscal 2019. We therefore think it's right to be long-term overweight in India. But I think the challenges in the short term are quite clear, which is that the market's very expensive. Earnings growth has been somewhat disappointing compared to the momentum of earnings growth elsewhere within the emerging markets. I think it is worth pointing out as well, however, that while India has been a consensus overweight for emerging market investors for several years, that overweight seems to have come down. And so I think a fair amount of foreign money has already come out of the Indian market, offset, of course, by the inflows, the increased inflows from domestic investors. So I think the short-term outlook is somewhat uncertain, but we still believe that India long-term is the best growth story within the emerging markets, and we would retain an overweight in the equity market for the long term.
What a few investors, though, Geoffrey, have started to worry about, and the bond markets are testimony to that, is any kind of potential shortfall in fiscal discipline or government revenue as well, due to the PSU bank recap or the GST tax rate cuts as well. Where are you on that?
Yeah. I think it's a very fair question. We have a very high number of foreign investors at our conference this year, and I suspect what they're doing is that they're in India to check out what these risks are, but also to see where the long-term growth potential is of the Indian economy, and therefore, of course, of Indian companies. Now, clearly, the risks in the short term, which are worth highlighting, which the market is focused on, is one, the rise in oil prices, which is always a negative for India because obviously India imports virtually all its oil. Secondly, there is some slippage on the fiscal side for sure, and some concerns about a slight widening again of the external deficit. And certainly our economists here do worry that ahead of the 2019 election, you could see some more fiscal expansion as well, which could threaten the budget deficit numbers. But overall, we tend to think the budget is in reasonably good shape long term. You will ultimately get the benefits to the budget of the introduction of the goods and services tax, which of course came into effect just a few months ago. And I think the fiscal monetary policy mix in India remains reasonably favorable. The RBI is doing an excellent job and may even have the scope to reduce interest rates over the next several months. So I think these are risks which are there. I'm not sure they're risks that are going to derail the markets, and certainly not derail the market over the long term.
I think one trend that I'm picking up from your answers, Geoffrey, is that long-term India is bullish. The short-term may be a bit uncertain. My question to you is, and I know it's difficult to either time the market or judge the extent of fall that could come in as well. But since you brought out valuations, I'm picking that point up. At the current levels where we are at, we might be trading at anywhere between 90 to 22 times, depending on what metrics or what earnings estimates every individual house has. What extent of fall or what extent of a minor correction would make India a comfortable, I'm not saying using the word cheap, a comfortable market to start investing back again into?
Well, we certainly think India is trading at about the 96th, 97th percentile in terms of its valuations today compared to history. So it is unquestionably stretched. And it's worthwhile pointing out as well that valuations are high across the emerging markets, but elsewhere in EM, you've seen much better earnings performance relative to expectations than you've seen in India. Whereas our Indian strategist has commented regularly this year, you've seen earnings being a little disappointing. Now, I actually don't think it makes a lot of sense necessarily to say, look, if you see India go down 10%, 15%, it becomes a value opportunity, because to a great extent, I think the Indian market will be driven by global events. And global events, of course, in EM have been very uneven suddenly over the last couple of months. Some of the riskier markets elsewhere in EM, such as in Latin America and EMEA, have pulled back significantly because currencies have been weak. Whereas, of course, in Asia, particularly in China and Korea, Taiwan, where the tech cycle has been very strong, the markets have done relatively well. So I think the best answer to say is that while we are always worried about currency risk and the rupee's come down a little bit, we don't think the rupee is particularly vulnerable at this level, frankly, having seen it come down through the 65 level. And as long as global markets in emerging markets generally do not pull back sharply from here, and we don't think they will do, I think the Indian market will will hold in relatively well. But if the question is, where do you have to go down to hit fair value, if you like, in India? Well, it could be 20% lower than we are today. But frankly, I don't think that's a realistic expectation, because India will be driven as ever by global events as much as by events at home.
Yeah, well, that's true. 20%, that would be great. But yeah, I take on board your point. You're just laying out a number. They're not saying that the markets would go there.
I don't want to say. Yeah, I'm not saying it will go down 20%. I'm just simply making the point. If you look at the chart and look at the valuation level, you can say, well, 20% would make it more fair value. Frankly, I don't think that's, as I say, a very interesting kind of analysis, because India is benefiting, just like everywhere else in emerging markets, is benefiting from a relatively low cost of capital. And so one thing to worry about in India would be if you were to see a big move higher in short-term rates or in bond yields, that would be a challenge for India. But I think we'll get driven to a great extent by what happens in global markets. And I think we're going higher from here over the next 12 months in global emerging markets.
Okay. Geoffrey, last couple of questions really. Almost everyone, on the investing side at least, has lauded this PSU Bank recapitalization move by the government, but believe that a meaningful up move in the PSU banking stocks was done and over with the immediate next day because of the move that we had. Now, my question to you is, I'm sure your clients would be talking about that, because that's that big change that has happened over the last 1 odd month in India. What are you telling them? I mean, is there money to be made in that PSU banking space, and could this bring down the risk premia in India a bit, and could that start off an investment-led cycle as well?
Very broad-ranging question. We certainly think the recapitalization of the public sector banks is an extremely important development for India in the long term. And naturally, the markets reacted, as you say, very positively when the news came out. Now, everybody knows, I think it's fair to say, both within India and people who are investing in India from the outside, that the public sector banks had tremendous balance sheet problems and did need this recapitalization. Timing of this announcement was nonetheless a surprise. I think it's a good piece of news. Now, I think what you have to do is to see, first of all, what the fiscal implications of that are, which of course are negative. It'll cost money to recapitalize the banks. And then I think you need to see how long this process takes, and what the impact of that is on the behavior of the banks themselves, and indeed on the behavior of the overall market and the overall economy. So I hate to keep saying this, but I think it's probably a very, very good piece of news for the public sector banks long term, for the financial sector in India long term, which of course is a big sector in the market. But inevitably, when you get this sort of surprise news, you may get an overreaction in the short term. And so I think we need to follow the fiscal impact of it, and we need to see how quickly this occurs. But this is one of the major imbalances, major structural problems that India has got, that they are trying to fix with this recapitalization. In that respect, it can only be seen as good news for the long term.
Great. On that happy note, Geoffrey, thanks so much for speaking to us at Bloomberg Quint, and have a great conference.
Thank you very much.
Well, that's Geoffrey Dennis of UBS, clearly positive on India. Of course, says that valuations may be a bit of a stretch, but very difficult to judge or gauge as to what's the quantum of fall that we could see into Indian markets, or for that matter, any markets. But bullish over the long term in India. That's the theme that they're going to tell their clients as well. Okay, moving on, moving tracks quite significantly from the entire market to some earnings. Bharat, and of course what's happening to that space as well. Remember, Bharat Forge is not the only beneficiary of the rising multi-axle truck sales in the US markets. Another Kalyani Group company, Automotive Axles, doubled its profits in the second quarter. To discuss the key highlights of the quarter gone by and to tell us where the growth lies for the company ahead, we are joined by Mr. N. Muthukumar, the President and Whole-Time Director at Automotive Axles. Good having you, Mr. Muthukumar. Thanks so much for joining in. Good morning. It's been a rock-solid quarter. Let's discuss all the elements one by one. The revenues first, 38%. Is this par for the course? Is this something that you foresee the company can reenact in the next couple of quarters or the next 1 year as well?
If you really see the commercial vehicle market, what happened is the first 2 quarters of this year have been slightly down because of the BS3, BS4 conversion and subsequently GST implementation. So the third and fourth quarter looks very, very strong. In second quarter, as you've seen, we have penetrated into the market. We have shown our agility in terms of delivery, and we shown in terms of our changes in the product that has happened in the market. We could be able to deliver well, which has taken our sales growth much ahead of the growth in the market. So we see continuously a good market, a very, very solid market in the next 2 quarters, at least for sure. And we are gearing up to produce similar results.
Wow. Okay. That's good to hear. I mean, is there visibility that you have for the rest of the year, or is this something that you can even forecast for FY19?
See, at this point of time, with the infrastructure spending is going on, we have seen a clear shift in the commercial vehicle axles with like what you said, the multi-axles sales has grown much higher, and the lower tonnage vehicles is coming down. So there's a clear shift in the market in terms of the multi-axle vehicle. There is a clear shift in terms of the infrastructure spending, particularly to the tipper model. So we see very, very strong demand, not only for the next 2 quarters, but also going forward in the next year also, FY18-19 also.
That's good to hear, Mr. Muthukumar. And how would this execution be done? 2-part question really. One, do you have enough capacity? I'm presuming you do, but just clarify it for us. Would you have enough capacity? What would be your capacity utilization levels be at this level? Or would you need to set up fresh capacity?
You already know, always the demand is what drives the organization. And our foresight of our management has always been good in terms of creating the capacity. We have created an agile manufacturing system which takes care of these type of fluctuations. And while we are trying to improve the existing utilization, we are at currently about 80% utilization. Obviously, you know, when the demand drives, we can do much better. We are also focusing on investing for the future, not only for the current product, but the future technology products that are coming in. We are launching a lot of new products, which is the new investments will be catering to meet those new challenges and new technologies also.
I'm guessing you're sufficiently funded for the same. You won't need to raise any capital for the same.
Absolutely.
Okay, great. What about the operational performance? Because I see this quarter too, there has been an improvement. Are these the levels at which you would presume your operational efficiencies would deliver, or do you think there is a scope for improvement here as well with revenue growth coming in?
Obviously, with the revenue growth coming in, I think we should our converting efficiency should be much better. While we are focusing on improving our operational efficiency consistently, quarter after quarter or month after month, but there's going to be a huge pressure in terms of the conversion and the cost escalation that is happening now. So always profitability will be under the constraint between the customers and the cost increases from one side. But we are confident that with our people and our capabilities, we'll certainly beat the expectations and grow forward.
No, I don't know what the expectations are. I mean, are the expectations 14% margins? Are the expectations 15% margins?
See, our wish list is always at the 15% margin, okay? But nevertheless, we need to have a sustainable growth also. It's not that we can jump into this because of the market growth. So we are very, very clear in terms of our approach. Whatever the growth that we are doing, it will be a sustainable models that will be going in. Like what we have committed earlier, year on year, we'll be adding up by a point and then grow up on the ladder.
Okay, fair call. A couple of questions really. One is on, I'm picking it from the answer that you gave. You mentioned that it is infrastructure spend which is driving demand for commercial vehicle axles. Would this be the principal driver, or are there newer areas coming in, defense for example?
See, we have, over a period of time, our dependency on commercial vehicles is coming down, and the new segments of business like defense and our light commercial vehicles is also on the way. So as you see that we have grown while we have continuously keep growing on the commercial vehicle segment, our sales from other segments is also coming in. Our supplies to defense has started. The amount of product launches that we have done in the last 2 years that is what is making us to outgrow the market more than the market what we have grown. So while we continuously focus on our key commercial vehicle segments, we will continue to focus on the other segments and keep growing. To your question of the growth, it's not only infrastructure, but the long haul track with the loading controls that have been brought in a lot of states, and with GST aiding in terms of the faster transportation and logistics advantage, people are going in for a bigger truck. Thereby, the cost per kg is brought down for the operational cost for the truckers. So this is the main another key driver which is driving the market. The growth of the multi-axle trucks has considerably grown in the last 2 quarters.
Okay, and secondly, I heard you mention that you are already launching or in the product of developing new products. Would these be across the spectrum of segments that you have, or are these predominantly being developed for the commercial vehicle basket?
No. If you see across the board, okay, we have launches in every segment which is that we have. Okay, whether it is military or an off-highway business or commercial vehicle business or light commercial. 70% of the launches in the last 2 years is with Meritor axles, and that's our success. The amount of money that we invested on new product launches is what is helping us to penetrate into the shares and getting into the market.
Okay, last question. Exports, by and large, if the recent export data is to be believed, isn't quite doing the best. I mean, different categories, merchandise exports, etc., has all come off. Apparel exports has come off. What has been your experience? Auto components per se, and what's the share of exports? Has it improved or has it remained stagnant?
No, we are remained static at about 7 to 8% of our total sales comes from export. Predominantly we supply to our Meritor joint venture partners, and we produce a niche products. So our predominant growth comes from the local market, but while we are eyeing in for a new products in the export zones also.
Great. Fair call. Lovely talking to you, Mr. Muthukumar. Thanks so much. Congratulations on a good quarter. Keep up the good work. And we'll talk again, maybe at the end of the next quarter. Thanks for speaking to us today.
Thank you very much. Thanks for taking the call. Bye-bye.
That's Mr. Muthukumar of Automotive Axles. Strong quarter. The stock is doing really well, though. 6% higher today after the 10% up move. The numbers pretty strong. The management confident of a 30-35% growth rate until FY19. At least that's the visibility that they mentioned they have, which is pretty strong growth forecast, quite frankly. Okay, just before we wrap up the show, though, remember there's a new listing. We'll mark that as well. But just want to speak about what's happening. Telecom is leading the pack. So telecom and telecom related. So Infratel, Reliance, Bharti Airtel are amongst the top 3 performers on the gaining side on the markets. Adani Port is that big loser in the session today. And just a quick headway into what's happening at the broader end of the spectrum. Reliance Naval is down 12%. That one has just gone down like a pack of cards in the session today as well. Not sure if that's the same for the other group companies, but Reliance Naval is certainly soft in trade today. We just mark Reliance Capital once before we wrap up the show. That should come up on your screen. Reliance Capital is under an eye of a storm yet again. Another 4.5% from 590 to 405. This one has had a terrible, terrible time the last 15 days. But more about this on the FNO show. For now, we wrap up Indian Open. The new listing as well coming up on the other side.